Good morning. My name is Scott Redler, Chief Strategic Officer at TWTR.com. Welcome to today's morning call. It's Monday. I hope everyone had a great weekend, had fun with the Super Bowl. Good to see Peyton Manning going off into the sunset, with another ring. Guy's a class act. I understand he didn't have his best game, but the defense spoke loud, and we talk about how offense wins games and defense wins championships, and that he can almost correlate that to the market, because there are times when you should be playing defense and times when you should, be on, risk on with offense. And one of my main rules is, if you're below the 8, the 21, the 100-day, the 50-day, the 200-day, you should be tactical and playing defense almost on every time frame. I go over that all the time, and when I go through the morning call and I go through all the charts, you're going to see how we've been below most of these major moving averages for some time, and it's actually starting to create some deep structural damage besides some of the technical damage that that has been adding up. So overseas, you have China closed for their lunar holiday, but Europe is getting really beat up. In my morning note, I talked about how if Europe breaks or the DAX breaks 9,300, you're going to see people notice, and I'm sure they'll talk about that on TV. And as far as our markets, we broke another level on Friday when we had that lackluster Jobs Friday. So if you take a quick look at the chart of the SPX, you will see, remember I told you about all the moving averages? Okay, well, all the moving averages were right here. This was your range to start the year. We closed right below the 200-day to start, and if you missed that, boom, this was your key support to start 2016. We did make a move and put in a flash low on January 20th, came back above. You had this small little wedge type formation that broke to the upside and brought you back to 1950-ish, which at that point put a small little double top in from down here. And then on Friday, I talked about the ascending channel here, that if we were to break and close below this 1900-ish, you better take some care, and that's why I'm actually short overnight, which is a little hard for me. So anyway, here is support that we're opening below. We're down about 22 handles in the S&P. Right here, this is 1872. If the market does not reclaim this 1872, at some point today, you could see more deterioration with, a level right here, which is where we're probably going to be opening around, which is this 1848, and then you have the low here of 1812. So at this point, if you are short from Friday, cover a little bit in here, and then if we can't reclaim this 1870-ish area, I would take a lot of care. We talk about bigger patterns here, and which I'm going to be on Bloomberg today if you want to watch at 1:30, and I've gone over this macro pattern with them, many times on why I think new money is really not coming into work yet, because if you look here, at a snapshot, going across, this is major support, but look how far we've come. Look at this double top that we took out way back when, and if you look at this head and shoulders top pattern that we've been talking about, we mentioned this right shoulder could be building, and a break below this 812, and you're in some trouble. There is a spot there that's that's actually the 200-day on the weekly, but you have this 1740-ish area right here, where I call it 1770, and then you have this like 1660-ish area. And then you have really the double top retest. And if you measure the move from 2100 even just down to like 1850, 250 points, what does that get you? Into the lower area. So that's why I feel like we've been trying to take caution. We trade every day for alpha. If you trade for alpha, you have to obviously manage the ebbs and flows of all the computers. But overall, which we mentioned, way back when in the first week or two of 2016. I'm like, if you want to reduce, my wife, I reduced her 401k to 50% cash, and everyone's like, when are you going to put that money back in? I'm like, not until at least under 1800 or closer to 1750 or maybe even below that. But anyway, that's that. So at this point, this morning we'll see, do we open lower and trend down, or do they try and reclaim that 1870-ish area? The Qs were really weak on Friday, and as I have the long-term chart up here, I guess let's take a look there. Some are saying you have a huge double top, which was hard to see when it happened, and then here is your your support that we're coming into, and then the bigger levels are all the way down here. So for the Qs that have come a heck of a long way, you got to take care, because it could be a long way down if you try and buy too early. And here you have 94.76. I'd write that down, and then really this 90.17. And let's go back to a closer look, because that's what we really trade here on a closer look. You had a few things going on here, to start the year. Again, the rules. Look what happened here to start the year. You broke the 200-day moving average. That meant weakness. Get out of Dodge. That was right around 108. Okay, and then you moved lower, and you just kind of had this bear-type flag pattern that just triggered to the downside. So now we're below basically the 2015 and almost a point of reference. So this is already this is below the January 20th low where the S&P isn't. So write this down. This is 97.25. 97.25 is, we're probably almost below there, around there now, and then you have this like 95-ish, and this was the area from the macro chart. But all in all, here's your first shot across the bow when we lost the 200-day and didn't reclaim it. Your bear flag continuation, and now we'll see what happens here. The IBBs and the Russell, they've been structurally damaged almost for 6 months to a year already. The IBB, you go to this chart here, and this loves to trade with channels, and here's when the first channel broke, here's when the next channel broke, here's when this one broke, and this is when 2015 lows were taken out and not reclaimed, and then there you are. So that's a definite weak chart, and you take a micro snapshot of that, and also below every moving average. Look at when it lost a 200-day right there, and now if you wanted to go a little bit more macro here to see where I guess it could find some kind of support, and big support I would say somewhere closer to this 240, and then really I guess it wouldn't surprise me if we really get that beat up, that this you could see something closer to a little bit below 220. But you could see how these trends work. This was your intermediate trend, and then you had another ascending channel, and then look where we are now. So trading using moving averaging as our rules, and looking at the overall complexion, and obviously what everyone's obsessing about, can help keep you safe and on the right side of things. The Russell, which tried to bounce for a few days, it too. Look when this lost a 200-day. And then this broke. This was the first sector actually to break the 2015 low. Little bounce up, and then you take a closer look here now. And this too, just like everything else, when you're trying to figure out when continuation could happen, well, it broke below this ascending channel with a low of Friday right here at 97.96. And now you'll see what happens here. How it handles the 2016 low, which is 95. So this could be day one. You don't know how many days it could be under there. You just had a range for almost 3 weeks. So that's why I also said with the spiders, which is why I'm short them, like this could have been your day one down. Okay, this was a pretty big range. You had your red dog reversal here. Okay, gave you 3 days. You actually had a little bit of follow through there, and then this small ascending channel that held earlier in the week got broken with some authority. So we'll see what happens now. We'll see if it stays below this 187-ish area. If it stays below 187-ish, cover a little bit into this 185, which we could see in the first 30 minutes perhaps. And then, if it doesn't reclaim that spot, this is the 2016 low, which, the tech is already there. And this is 181.02. So let's go into the FANG names that we've lost one by one. They've given you clues on, you have to be a lot more careful. One, when they're below their 8 and 21 day, any momentum stock turns into just a tactical trade. But then if they start losing the 50, the 100, the 200 day. So anyway, Netflix was the first one to really weaken and fell into earnings. And, guys have actually been making some money short this thing. This was your descending channel here. Great. This, I think, was the day it failed after earnings. And then this was like, okay, Netflix just changed. What did it do? Went below the 200 day. It actually changed up there, but below the 200 day, this was or 100 and change. So, you could always save yourself some pain. This was like a 101, okay? And then the most recent area it broke was right here. This was your 90. And now you have, a pivot low down here of 81. So you want to now start going to your left to see where there's some support. I guess there's some major support here with this huge gap up, which is right around 75. It's come down a long way, and it's opening lower today. So maybe for a trade, it's worth a look versus a level. So what I'm going to do with these high beta names that are down 4 days in a row harsh, I'm going to see if they put in a 15, 30-minute low. If the futures continue to go lower and they don't go down anymore, maybe I'll buy versus that low and see if they try and lead us off the lows and go green, okay, because they've been so battered and bruised, and thank goodness I'm not in caught in many of them. But again, just like Friday, people tried to do that same trade, but they didn't get out when it broke a low, and they started cost averaging in, and they puked it out at the end of the day and had a horrendous day. You don't want that to happen. That's how you go out of business. So anyway, you go back to Netflix, you'll see here that this will, maybe it comes back and tries to reclaim that, but this would be a spot. But if it gets also into this gap, you got to be really careful because, look how far down it goes. This gap was one of those earnings gaps that go all the way down into the low 70s. So you have to take a lot of care when it comes to that stuff. And you look at this trend, look at that. Right there was broken. I would say you got to take a snapshot of that. Netflix, look at below every moving average when the trend broke. So let's go to the next one, the next culprit, which was Amazon. They missed earnings, gapped lower, never filled the gap. I remember the price, I think, was $5.93. And then some guys made good money shorting $5.70, $5.50, and it lost the 200-day. So, you have to say to yourself, if a strong name like Amazon that everyone loved lost the 200-day, it might be able to happen to any name out there. So you have to be very careful just trying to buy the 200-day because sometimes it bounces the first time and then the next time it fails. So here is your gap down after earnings. Okay, hold on, which it never filled. And then this was that 2-day pivot that I wrote in my note. Some either used it as a stop or maybe even as a short. That's when it broke this, let me just get this out of the way. This was 570. And then it broke the 200-day. You had a small little bounce and then continued lower. So closed on the lows. Barron's has a positive article on it, so maybe it gets a little bit of a focus, so you can focus on that today to go green. You go sideways. I'm trying to look for levels here too. Really, a major level, if you're going to be, very, patient, which might not be today, is down here. This is closer to your, 451-ish. There is a point of reference right around here, if you want to try for a micro trade, but this is really a better spot. And again, it's below every moving average. You never know. This is still not even at 2013 levels of 2014. Look how far it came. So people are like, oh my God, it got so beat up. It has, but it's come from a heck of a lot lower. You could draw this trend line and look where it came from. So anyway, this would be an intermediate spot, and this would be a very, I would think, compelling spot, especially if it happened fast. So we'll see what happens today. I will also be looking at this, but I'm going to do a level versus a level, not a cost average game. And we'll see what happens. Google, I think a lot of people got hurt because they're like, oh, it's had a great earnings, but I'm just going to buy it because they're going to come save it. But meanwhile, you remember we talked about if it doesn't hold 800, get out of Dodge, and then it filled the gap so friggin' fast. And then I think people just started buying it, saying it has to bounce, but things don't have to bounce. So anyway, here is the 200-day. So this is your 2016 low. You want to write that down. That is 687, and then the 200 days at 674. So I would think 1, 2, 3, 4. On the 5th down day, there is a spot that you could get a good trade, and I'm going to look there too. But be careful. Do not get too big. You get too big, you're going to get pushed out. So I would say, try it maybe around here or into there. But the way I would do it that could not be so volatile is let it put in its low, let the futures continue down, let it show some relative strength, and then buy versus that low and take your hands off the keys. And if it happens to never go back there and go green, you caught yourself a nice trade. The stocks come off 4 harsh days. That's how you should look at these high beta names. In fact, Facebook, this gave you that 4-day move. I sent out the chart, and then look at this red dog reversal right here. That was your sell signal. You didn't know that was going to happen, but you didn't have to if you get out of the way. And then, some guys actually made some good money because you see this doji right here. When you have a doji, okay, and then it trades below the low end of the doji, that's your other signal that confirms the topping tail. And then boom, boom, boom. And now, it traded into the gap on Friday from earnings, and now it's just in here. Okay, there is, I would say there's probably going to be some support around this 101. But you can't rule out, a move all the way down to fill in the gap. And then just like every other, I know this had a great, strong, awesome report, but the 200 days all the way down here. You already have Amazon through the 200-day, Netflix through the 200-day, Apple's through the 200-day, Google might be touching it today, so you don't want to start too early just because this was the best name for, a few sessions when everything rolled over. So see if it can hold here. My best call for you to do here is, again, level versus level. Do not just cost average in because you don't know. LinkedIn is one of the culprits that put the fear of God in everybody because it showed that, a big name at some point is going to slow down and it could be down 40%. And look where LinkedIn, oh my God, look at, this was the highs. The highs here on LinkedIn were close to 280, close to 108, back to levels from multiple years ago. I remember, because I used to be all over LinkedIn, that cup and handle pattern back here. This was the last time we had some really good trades and boom, boom, boom. Well, look where it's back to, round trip. A lot of these things could always make a round trip. That's why, again, you don't want to overstay your welcome, especially when they start breaking below moving averages. And, you go back to LinkedIn. Was LinkedIn below all of its moving averages heading into earnings? Yes, they were. They're up here. Okay. Plus, as traders, you don't take things into earnings. So anyway, for today, if you're looking for a trade, I think Barron's also had a little positive article on them. Use this as your pivot. Your pivot right here for LinkedIn is 102.81. If it's below that, stay the hell away. If it does a red dog or reversal around it, maybe try some. Twitter has earnings on Wednesday. This stock has been broken for quite some time, and it's been trending well below. Look when it broke the 200-day. If you got out of it when it broke the 200-day here, you haven't had any of this damage. I know we looked at it one time over here. This was your last, intermediate spot to get out of Dodge. That was at 28. I don't think I've really touched it since. And now it's struggling to hold on to this, 1540 area. And look at how it's below everything. Twitter's below every moving average. So this was one spot to get out, and then here was, your next spot once it broke. It's lots of areas to look at here. But anyway, on a micro time frame here, see if it gaps down and maybe it tries to go green, but this is the pivot. This is 1548. Underneath there, there's nothing really to your left, and it's got earnings on Wednesday. So, just take a little care. As far as, always what's been in the news as the culprit for everything is oil, but I think there's a lot more than just oil. The USO and oil is back below 30, so watch that today. Talked about this small little rising channel here that it broke. And now, I guess, see what happens here. Does the oil hold, or does the USO hold this 856? Below 856, the lows are all right back here, So, and again, look how structurally broken all this is. We'll see. A lot of people are starting to call, that was the bottom. We'll see. We'll see how it acts today. The XLE, again, we want to talk about structural damage. Look at this trend that was broken multiple, years ago. Okay, not multiple, yeah, maybe, 2014. Look when it lost the 200-day. It's been below it ever since. Not investment quality. I don't care about ExxonMobil and CVX, et cetera, And then you've had, a break here, another break here. But structurally, you can take a snapshot of that. Look at the structural damage in the XLE. So here now is your most recent, bounce off the lows. And now the question is there any type of commitment to it? So we shall see. It's not off that much today. And I guess, what would be a decent level here to watch? I guess this is a lot lower. Right around here, I guess. This gave you a little topping tail. So that was your sell signal, little follow through. So if you're short, this would be probably a decent spot to cover a little bit. And if you're looking to see if it shows any relative strength and any kind of commitment, you would think it would hold above this 54.11-ish. Now, onto what the bugs have been dancing to is the strength in gold in 2016. Gold's been in a 2-3 year bear market, and finally the GLDs reclaimed their 8 and 21-day moving average, which happened weeks ago, and it's been following it since, giving guys a lot of good trades. I've had it in the note and posted some charts. I myself hasn't been trading it, unfortunately. I did actually, it's so funny as a trader. I was getting involved in here, thinking that it was getting ready to go. Nice little lower pattern, and then this little move got me out, and since then I've only been writing about it. But anyway, this is when it really took back the 8 and the 21-day, and here's when it triggered above that 106, and now boom, took back all the moving averages and closed real strong. And your next level here, is 114. I don't know if I'd be chasing gold here, but if you start just shorting it because it's been so weak the last year or two, you can get really hurt. Now it's, it's extended from the 8-day, but it's above that. It's above the 21-day, acting much better. You want to look at, a longer-term chart of gold, and you'll see there is a big downtrend here that it's poking. It's going to be actually it's kind of poking through. Remember when it broke its uptrend? When this is when you should have been out of GLDs, when it lost the 200-day, just like everything else, right there, boom. Okay, so that was your out. Now it's trying to change a little complexion. Maybe, hold on, let me get this out of the way. Take a little picture of this. This was the GLDs, and now it's trying to reclaim and trade above this. If it were to trade above this descending, let me get you this descending channel here, perhaps, that tells you something about the overall market too, but, it could get up to, let's see, where can gold go? Who knows? This is 120. This is closer to 125-ish. So this was your A move, and now we'll see if there's any more. But again, I wouldn't be chasing it there or shorting it. I think you missed some of those opportunities. The miners also had a big move. That's a junior miners, a GDX. Wow, look how bad it is. Like people are saying, I'm going to go short the miners. I'm like, look where they were. Look where they're just poking their head out. So as good of a trade as it's been short term, like treasures for trash for guys who haven't been in it. Just take a little care. Just trying to short every move now. This was, I guess, your buyable move above this pivot if you didn't get it off the lows, and then it took back the 200-day. So it is extended, but again, this thing was 60-ish. It's at 17. Just be careful if you're just going to be shorting it. My theory on days 1, 2, 3. You don't want to be buying it somewhere on the 4th or 5th day, but these things have been battered and bruised, and I guess money needs somewhere to go. So in closing, we got to see what happens here. Friday did give you some clues to reduce some risk again, maybe even position short. The S&P, we're coming into some decent support in 1845 to 1855 in the SPX. So if we stay below 1870, that'd probably be one spot that they try and bounce off of. If they can't bounce there, and oil gets below 30 and stays below 30, and tech breaks that pivot of the 2016 low, you could see 1812. So don't just blindly buy. I know high beta tech had 4 down days, harsh. So into today, I would say maybe we get some opportunity to just do a buyable trade if they show relative strength. But then you better be careful to love them and leave them, because these have been broken and they're not the same the way they were, over the course of the past year to 3 years. So you have to recognize when things change. And strong defenses win championships, even in trading, because that means you could stay in your career and in your business if you know how to operate during any environment. And right now, if you're a bull, you're on the defensive. If you're a bear, you've actually been on the offense pressing. And we'll see when that equilibrium hits, and we'll have to have our levels in front of us and make sure you're thinking clearly. Otherwise, you can get caught up and really put out if you do that catch a falling knife game, which is not the way to do it as a trader. I'll be on the radio. I'm going to post some charts. If you want, I'm going to be on Bloomberg at 1:30 today, Benzinga at 9. You can follow me on the virtual trading floor, and let's put this week together and see how we could make the most of it. Have a great day.